Here is a question that has started more arguments in investing communities than almost anything else. Two investors, same amount of money, same time horizon. One builds a carefully curated portfolio of dividend-paying stocks, companies that send them a check every single quarter just for owning shares. The other one buys a boring, plain total market index fund and never thinks about it again. 25 years later, who has more money? The answer is not what most people expect, and the reason why is going to completely change how you think about where you put your dollars. Welcome back to Kaggy Invests. Today we are getting into the math behind one of the most passionate debates in all of personal finance: dividend stocks versus index funds. We are following two investors, same starting point, different strategies, and we are letting the numbers tell the truth. No hype, no agenda, just the real math. Let's go. Meet Dana and Chris. Both 32 years old. Both just came into $40,000. Maybe an inheritance, a bonus, a few years of disciplined saving. Both plan to invest an additional $600 a month going forward. Both have a 25-year time horizon. Neither one needs this money until they're 57. The only difference is the strategy they choose. Dana is going the dividend route. She is building what the investing world calls a dividend growth portfolio. Companies with long histories of not just paying dividends, but increasing them every single year. Think established blue-chip names across utilities, consumer staples, financials, and healthcare. Companies that have paid and raised their dividends for decades through recessions, crashes, and everything in between. Chris is going index fund all the way. One fund, total U.S. market. Automatic contributions. Expense ratio of 0.03%. Set it and forget it. Let the game begin. Chapter 1. The philosophy behind money. Dana sits down with a legal pad and writes out her first 15 dividend stocks. She is looking for companies with a dividend yield between 3 and 5%, a payout ratio below 60%, meaning the company isn't paying out more than it can afford, and at least 10 consecutive years of dividend increases. She calls this her sleep well at night portfolio. Dana's inner voice: I don't want to guess when to sell. I don't want to watch a number on a screen and wonder if it's enough. I want income. Real quarterly income deposited into my account like clockwork. When I'm 57, I want to live off dividends without ever selling a single share. My portfolio becomes a goose that lays golden eggs forever. This is the emotional core of dividend investing, and it is powerful. There is something deeply satisfying about receiving a payment, actual cash, from a company simply because you own a piece of it. It feels real in a way that watching an account balance grow does not. And for retirees especially, dividend income provides a psychological comfort that total return investing sometimes cannot. Chris, meanwhile, opens his brokerage account, types in his index fund ticker, sets up a recurring $600 monthly purchase, and closes his laptop. He is done in 11 minutes. Chris's inner voice: I own a tiny piece of every major company in America. When Apple wins, I win. When Amazon wins, I win. When some company I've never heard of suddenly becomes the next big thing, I win that too, because it's already in my fund. I don't have to pick. I don't have to research. I don't have to be right. I just have to stay. The narrator needs to draw a critical distinction here. Both strategies involve owning stocks. The difference is in how returns are delivered. In a dividend portfolio, companies send you cash periodically. This is income. In a total market index fund, those same returns are often reinvested back into the companies automatically, growing the share price instead. This is called total return. Price appreciation plus reinvested dividends combined. The question at the heart of this debate is not which feels better. It is which one builds more actual wealth over time, and why. Chapter 2, 5 years in. The income starts flowing. 5 years in, Dana's dividend portfolio is generating some real income. Her $40,000 initial investment plus 5 years of $600 monthly contributions have built a portfolio worth approximately $130,000 at a blended average total return of around 9%. Her dividend yield on that portfolio is about 3.5%. That means she's receiving roughly $4,550 a year in dividends, or about $379 a month, deposited directly into her account. Dana is reinvesting all of it right now because she doesn't need the income yet. But she can see it. She can feel it. Every quarter, the deposits come in. 14 companies on her list have already raised their dividends since she bought them. The compounding is beginning to feel real. Dana's inner voice. Every time a company raises its dividend, my income goes up without me doing anything. I didn't get a raise. I didn't work harder. The companies just sent me more money. This is what passive income actually feels like. Chris's portfolio at 5 years, with the same contribution schedule and a 10% average annual return, matching the historical stock market average, has grown to approximately $148,000, about $18,000 more than Dana's at this point. The difference is not dramatic yet, but it exists, and here is why. The narrator steps in. The total market index fund historically returns around 10% annually over long periods. A carefully constructed dividend portfolio, while it receives income, often holds more conservative, slower-growing companies, utilities, consumer staples, real estate investment trusts that prioritize paying dividends over aggressive reinvestment for growth. Those companies tend to grow their stock price more slowly than the broader market. So the dividend investor accepts somewhat lower total capital appreciation in exchange for current income. Whether that trade-off makes sense depends entirely on where you are in life and what you need money to do for you. There is also something called tax drag to consider. When Dana receives her dividends, even though she's reinvesting them, those payments are a taxable event. If she holds these in a regular brokerage account, she owes taxes on those dividends every single year, even if she never touches the money. Qualified dividends are taxed at the long-term capital gains rate, which is more favorable, but it still creates an annual tax bill that erodes compounding. Chris, who holds an index fund with very low turnover, generates almost no taxable events until he decides to sell. His compounding is essentially uninterrupted. This is the hidden cost that most dividend investors never fully calculate. Chapter 3, 12 Years In. The System Shock. Year 12 brings a recession. A real one. Not just a correction. An actual economic downturn. Stock prices across the board fall 25 to 30% over 14 months. And here is where dividend investing shows both its greatest strength and its most important vulnerability at the same time. Dana's portfolio drops in market value along with everything else. But her dividend income does not stop. The vast majority of her companies continue paying their dividends through the downturn. Some even raise them, because strong companies with durable business models generate cash flow in good economies and bad ones. Her quarterly deposits keep arriving. She doesn't feel the need to sell anything because she isn't dependent on the share price. She is dependent on the income, and the income is still there. Dana's inner voice. My account balance dropped. It looks terrible on paper. But my dividend income this year is actually higher than last year because 3 of my companies raised their dividends even during the recession. This is the whole point. I don't care what the price says today. I care what the income says. And the income says I'm fine. This is genuinely one of the most powerful psychological advantages of dividend investing. The income provides an anchor, something concrete to hold on to when prices are terrifying. Chris's portfolio has also dropped significantly in market value, from a peak of around $310,000 to roughly $225,000 on paper. He feels it differently because his only signal of progress is the account balance. There is no quarterly deposit to reassure him, just a number that got smaller. But Chris does not sell. He keeps his $600 a month automatic contribution running, and because prices are lower, every $600 buys more shares than it did before the crash. He is loading up on ownership of the entire U.S. market at a discount. When the recovery comes, and it always comes, those extra shares multiply his gains. The narrator here needs to address something important about dividend cuts. Not every company maintains its dividend during a downturn. Some cut them. Some eliminate them entirely. In 2020 alone, dozens of well-known companies suspended or cut their dividends. For a dividend investor who built their strategy around a specific income number, a cut is a double loss. The income drops and the stock price usually falls sharply on the announcement. Diversification across many dividend payers reduces this risk, but does not eliminate it. The index fund investor experiences no equivalent of a dividend cut, because the index simply absorbs the underperforming company as a smaller percentage of the total. Chapter 4. 20 years in. The wealth gap widens. 20 years in, both portfolios have recovered fully from the recession and continued growing. Dana's dividend portfolio has compounded beautifully. Her income machine is now throwing off approximately $1,650 a month in dividends, just under $20,000 a year, and she is still reinvesting every cent. Her total portfolio value sits at around $680,000. Her dividend income has more than quadrupled from year 5 because of the compounding effect of reinvested dividends plus the annual dividend increases from her holdings. This is what the dividend growth investors call a snowball. Slow at first, then unstoppable. Dana's inner voice. In 5 more years, when I stop working, I'm not going to need to sell anything. I'm just going to flip a switch and start taking the dividends as cash. My portfolio becomes my paycheck. That's the whole dream, and I can see it from here. Chris's index fund account has compounded at the full market rate. 20 years of contributions plus his initial $40,000 at 10% average annual return has grown to approximately $890,000, about $210,000 more than Dana's portfolio. The gap has widened steadily, primarily driven by 3 factors: slightly higher total return of the broad market versus the more conservative dividend-heavy holdings, no tax drag on unrealized gains, and the full compounding of every dollar, including those that would have been paid as dividends in Dana's portfolio. The narrator needs to acknowledge something that pure math sometimes misses. Dana's $680,000 and Chris's $890,000 are not equivalent in terms of what they do for her life. Dana's portfolio generates income without touching principal. Chris's does not. To generate equivalent monthly income, he would need to sell shares on a schedule, which introduces what retirement planners call sequence of returns risk. If the market drops significantly right as he starts selling, he locks in losses at the worst possible time. Dana's dividend income does not require selling. That is a structural advantage in retirement that the raw numbers do not fully capture. Chapter 5. 25 years. The final math. The finish line. Both investors are 57 years old. Dana's dividend portfolio, total value approximately $870,000. Monthly dividend income, approximately $2,400 per month and growing every year. She flips the switch. She stops reinvesting. She starts living. She never has to sell a share to fund her lifestyle. Her portfolio continues growing even as she spends the dividends because the underlying companies are still appreciating. Her money is genuinely working for her around the clock. Chris's index fund account, total value approximately $1,180,000, about $310,000 more than Dana. But to generate the same $2,400 a month in income, he needs to withdraw from his portfolio. Using what financial planners call the 4% rule, a widely studied guideline suggesting you can withdraw 4% of your portfolio annually in retirement without running out of money. Chris can safely take out about $3,930 a month, more than Dana's dividend income. His larger base of wealth gives him more income potential, even though he has to sell to access it. So here is the final honest scorecard. Chris built more total wealth, $1.18 million versus Dana's $870,000. The index fund wins the wealth-building race over this time horizon. The broader market's higher total return and the absence of tax drag on unrealized gains compound into a significant advantage over 25 years. But Dana built more peace of mind. She has a natural automatic income stream that requires no selling decisions, no withdrawal strategy, no worrying about sequence of returns. Her income will keep rising as long as her companies keep growing. For many people, especially those who will struggle psychologically with selling assets in retirement, that peace of mind has real financial value because it prevents panic decisions that destroy wealth. The honest conclusion is this: if your goal is maximum wealth accumulation, index funds win. If your goal is reliable, growing, never have to sell income in retirement, dividend growth investing is a deeply compelling strategy. And if your goal is both, which it probably should be, you hold index funds in your accumulation years, and you gradually shift toward dividend payers as retirement approaches. You use the wealth machine to build the income machine. That is what the smartest long-term investors actually do. The rule that both strategies share. Here is what Dana and Chris both got right, regardless of which strategy outperformed. They started early. They contributed consistently. They did not stop when the market crashed. They did not check their accounts every day looking for reasons to panic. They let time do what only time can do. Dividend stocks and index funds will both make you wealthy if you stay the course. The investor who picks the wrong strategy and sticks to it will almost always outperform the investor who picks the right strategy and abandons it when things get scary. Behavior is the single biggest variable in long-term wealth. Not the fund, not the yield, not the expense ratio. You. The best investment strategy is not the one with the highest theoretical return. It is the one you will actually follow for 25 years without blinking. Pick the one that lets you sleep at night. Automate it, leave it alone, and let the math do the rest. Wealth is not built in moments of inspiration. It is built in decades of consistency, and it belongs to the patient. Now, speaking of decisions that quietly cost you a fortune, the next video is going to save a lot of people from a very expensive mistake. We are doing the real math on leasing versus buying a car, and the numbers are going to make you look at that shiny new lease offer very, very differently. Do not miss this one. Click that video right now. I'll see you there.